In today's market update, we're going to be taking a look at the insight that the 20-day cycle FLD provided us with last week. Before we do that, I must ask you to please make sure that you have read and understood these disclaimers. In last week's market update, I discussed the anomaly that the markets have been presenting us with recently, which is this fairly prominent trough in October of last year. I say that it is an anomaly because the wavelength of the cycle that played out from October 2022 until late October 2023 is 378 days or 54 weeks. Only just a little bit over a year. Now, we do not have a 1 year long cycle in the nominal model that we use to analyze the markets. The nominal model, just a reminder, is of course the list of cycles that we use to perform our analysis. The nominal model that we're working with here is in fact the nominal model defined by Hurst over 50 years ago. And there is a debate to be had as to whether we should be adjusting our nominal model to account for changes in the market. And I will be exploring that idea in a video soon. But for now, we're working with Hurst's default nominal model because it has worked very well over many, many years. And so how do we resolve the anomaly of this 1 year long cycle when the 40-week cycle, which is one of the cycles in our nominal model, has an average length of 272 days, and the next longer cycle in our nominal model, the 18-month cycle, has an average length of 546 days. And so where does a cycle of 378 days fit into that picture? I discussed this in last week's market update, and if you haven't seen it, I would encourage you to go back and take a look at it, because I'm not going to repeat the discussion that we had last week, except to point out the fact that there are in fact 4 possible solutions. The first possible solution is to work with a different nominal model. And as mentioned, I will be exploring that idea in a video soon. The second solution is the one that you see on this chart over here, which positions the 40-week cycle trough in this rather arbitrary position in June of 2022. You can see there was not really much of a trough in the price action, and that means that the trough that formed in October of last year is a 20-week cycle trough. And so this solution could be called the 20-week solution. The third solution, which I discussed last week, is the possibility that this trough in October of last year is in fact an early 18-month cycle trough. We'll take a look at a chart in a moment that displays that option. So this option we will call the 18-month solution. There is a fourth possibility, which is that the trough that formed in October of last year is in fact of 40-week magnitude. You can see, disregarding the nominal model discussion for the moment, that the big question that we have has to do with the magnitude of this cycle trough that formed in October of last year. Was it a 20-week cycle that formed, a 40-week, or perhaps even an 18-month cycle? The difficulty with this analysis is that it expects the next 18-month cycle trough at the beginning of March. So we're only about 5 weeks away from that 18-month cycle trough. You can see that the cycle shapes just don't really make sense, because we should have a 40-week cycle shape over here. That's that M shape, with a very disappointing fourth leg to that M shape. And then we should get our second M shape over here, like that. It just doesn't really work. And so we could consider the possibility that the trough that occurred in October of last year is a trough of 18-month magnitude. Here is what that analysis looks like. You can see that we have an 18-month cycle trough below the trough in October of last year. Certainly the idea that an 18-month cycle trough occurred in October of last year explains the tremendously bullish run that we had out of that cycle trough. We also have some fairly good, sensible cycle shapes. We have a clean M shape for this first 40-week cycle, and then we have a less clean but nevertheless fairly balanced M shape for the second 40-week cycle. The problems with this analysis are that this is a very short 18-month cycle, being, as we have already seen, just a little over 1 year long, meaning that the cycle is only 69% of the average length of that 18-month cycle. Now, often people ask me, what is too short for a cycle, or what is too long? because we know that the principle of variation is alive and well and that these cycle wavelengths are dynamic and are constantly varying. As a general rule of thumb, the answer to that question is that 2/3 of the cycle length is about the shortest we could expect. And so at 69%, this cycle is not impossibly short, but it is certainly on the edge of being so. What about the other possibility that this trough over here is not of 18-month magnitude, but is of 40-week magnitude? That would mean that this trough in March of last year would be a trough of only 20-week magnitude, and these 20-week cycles would become 80-day cycles, and these 80-day cycles would be 40-day cycles, and so forth, all the way down the chain of the analysis. The only problem with this is that means that that would be a very long 40-week cycle at about 139%. Again, what is too long for a cycle wavelength? As a general rule of thumb, we use about 150% as the limit, and so at 139% that is not impossibly long. The interesting thing, in my opinion, is that it doesn't really matter to us whether this was an 18-month cycle trough or a 40-week cycle trough that formed in October of last year, or to some extent whether it was in fact only a 20-week cycle trough. The reason I say it doesn't make very much difference is because in terms of our trading and the time span that we're generally looking at in these market update videos, which is looking forward only a few weeks at a time, we can make sensible trading decisions even despite some uncertainty about the magnitude of the trough that occurred last year. And that is really the focus of today's video. But before we take a look at the detail and discuss what happened last week and what insight the 20-day cycle FLD gave us, let's quickly consider what the difference is in terms of the magnitude of that trough last year. Perhaps the easiest way to understand the implications in the difference between two analyses is to take a look at the composite model line, which is this dashed orange line on our chart. The composite model line takes the information from the analysis, recomposes it, and presents us with the price action that would have resulted from the combination of the cycles that have been found in that analysis. That cycle influence is then extended into the future by assuming that the wavelengths will remain constant and the amplitudes will remain constant, and the result is a useful indication of the implications of the analysis. And so in this case, where the October 2023 trough is of either 18-month magnitude or in fact 40-week magnitude, the implications are the same. We have had a very bullish 80-day cycle, and now we are going to witness a less bullish 80-day cycle. Price is now rising up to a peak, and then it is going to come down into this next 80-day cycle trough, which will also, of course, be a trough of the 20-week cycle in the beginning of March. Then price will rise again, possibly forming an even higher peak, and then the next time to watch for an important trough forming is in early June of this year. The other analysis presents a different picture, as you can see. If this trough was of only 20-week magnitude, we would have expected price to already peak. This price action that has occurred over the past few weeks implies that this analysis is not in fact the correct one, because according to this analysis, the market should now already be moving down into this trough expected at the beginning of March. The interesting thing, of course, is that both analyses are expecting a trough in early March. But bullishness at this time would imply that the trough that occurred in October of last year was of either 18-month magnitude or possibly 40-week magnitude. So let's zoom in and take a look at what happened this past week. I mentioned last week that we needed to keep an eye on the 20-day cycle FLD. And that is because of the sequence of interactions that we watch very closely between price and the FLD of any cycle. Not only do we watch that sequence of interactions, but we are also able to trade the sequence. We have identified this 80-day cycle trough as having formed on the 5th of January, and the first interaction between price and the 20-day cycle FLD occurred over here between the 9th and the 10th of January, where price crossed up above that FLD. We label that an A category interaction, and that generates a target to the upside. That target is at a level of 48.65, a target that has not yet been reached. And I pointed out last week that the fact that it hadn't yet been reached might warn of impending bearishness. In other words, the possibility that this market is about to turn down. However, at about the time that the 20-day cycle trough forms in this market, and you can see this 20-day cycle trough was pretty much expected at the end of last week, or over the weekend in fact, we would expect price to find support at the level of the 20-day cycle FLD. I think you can see very clearly what happened on Wednesday of last week. Price came down to that 20-day cycle FLD and it slipped below it just for a brief period of time and then bounced back up again, clearly finding support at the level of the 20-day FLD. On Thursday, price again dropped down below the level of the FLD because of the fact that the FLD was, of course, rising. FLDs provide fascinating, previously hidden and dynamic levels of support and resistance, and you can see that playing out last week. This was a textbook example of price finding support at the level of that FLD. The fact that it did so a few days early is a sign of continued bullishness in the market. When the underlying trend of the market, in other words, the sum of all the longer cycles, is bullish, we expect troughs to occur early. In a balanced market, we would expect price to find support at the level of that 20-day cycle FLD, which is exactly what it did. If it was turning bearish, we would have expected price to slip below the FLD, failing to find support. And so the insight that that interaction with the FLD provided us with was the fact that this bull is still alive and healthy. The analysis possibility that leads us to expect the market to turn bearish is not turning out to be the correct one. And so for now, we are watching this market unfolding in a bullish manner. Price must still reach up to achieve the target of the 20-day cycle FLD and will reveal its bullishness by how far it exceeds that target. After which, of course, we will be looking out for a 40-day cycle trough, probably in the first week of February. And then, of course, don't forget that important trough coming at the beginning of March. I do hope you found this market update useful and interesting. If you have any questions, please put them in the comments below the video or join us on our Discord server.